Howdy, Jacob here. Today we're looking at Saga Communications, ticker symbol SGA. Let's get into some of the financials here. So it's a media industry, $130 million market cap with an $89 million enterprise value. So good to see that they have more cash on hand, net of debt. It looks like they're in the radio station business specifically. Their current yield is 4.6%. And their market cap of 134 million is very small. So I'm going to look at their insider ownership, and a quick look. It says 19.6% held by insiders. Great, means they have a stake in the business. So the decisions that the board makes will likely be is more going to be in line with um, yours as the owner of the company through owning the stock. And so the ROIC the last 5 years or so hasn't been too impressive. We're seeing, mid single digits. The gross margin and operating margin have both declined fairly substantially over a 10-year period, 28% down to 24% on the gross margin side, and then on the operating margin side, 22% down to 11. So pretty big hits there, but they have, it looks like, paid a dividend since 2014, so that's good to see. For this screener, obviously, pretty consistently outside of a crazy 2017. They, which I don't know how this net income number got to this 55. That doesn't add up, but anyways, they average in the low to mid double digits, but it has been going down. Free cash flow side, it was low 20s, and then mid-teens, and now we're at low double digit, mid double digit. Okay, and they don't really do anything outside of pay down debt and pay a dividend with their free cash flow. And so their payout, this says 30, but if you take their yield times their market cap, so the yield of 4.6 times their market cap, you actually get a $6 million payout. And so they can afford a $6 million payout pretty reasonably. Let's see their balance sheet. Let's see how much cash they have in comparison to debt. Okay, very good balance sheet. Okay. So we have 47 million, including short-term investments on their cash, like investments or products. And then long-term debt, they actually have zero. Short-term debt, they also have zero. So we have a very safe balance sheet here with 68 million in total current assets and 62 million in all of the liabilities. So that's not necessarily something to invest in, but something that's going to make the investment feel a bit safer. And then let me see acquisitions or devastation. None. Okay, so the business has been organically growing, it looks like, unless it's embedded into property, plant, or capital expenditures, and it's been relatively flat. And so my first assumption is going to be this business doesn't go up, doesn't go down. Maybe it declines, but with inflation, they'll be able to charge more. So it's going to be a pretty flat business. Margins have been very consistent, and they have no debt. And so an increase in interest rates, as long as they don't go into debt, won't really affect them as much. And so I think if I do maybe 9, 11, 0% share change, and then on the dividend increase, I mean, it's $6 million payout. I mean, they don't do anything else with their money, and so due to that, I might just say they'll increase it a little bit to where it becomes maybe a $7 million payout. And I mean, with them averaging low double digit, yeah, it might be as high as like a 65-70% payout ratio, but they don't do anything else with their money. And so, yeah, you might want the business to buy back shares that are stupendously cheap, or make acquisitions that make the most sense to grow for them, or make investments that make sense for them. But in reality, if you look at past and the the same board is there, the same CEO, CFO are there, it's likely not going to change the way you'd want it to. And so capital allocation does absolutely depend on what's been done in the past. And so maybe their capital allocation isn't perfect, but that's put into our assumptions here. And so that gets us to a stock price that needs to fall quite a bit, about 50%, before we get a 15% return given these assumptions. And so for now, with everything, I think it's in the radio media industry. I don't see immense growth from that perspective. And so I think my 0 and 10 on revenue change and price to earnings and price to free cash flow are pretty fine in line. But this is a business with a very fantastic balance sheet, no debt, a fair amount of cash on hand, especially in relation to their dividend payout, and they've been producing free cash flow very consistently. And so this is definitely a company that I think should be on a dividend yield screener. But right now, I think the price appreciation doesn't make as much sense, or doesn't make enough sense to invest in it to get a return that actually makes sense beyond the 4.6% dividend yield. So I hope everyone enjoyed the video and has a great rest of their day. Thank you so much.